IVM.
India's got a bright future. Here's a line I wrote in one of my pieces with Mint. Be super bullish on India, but be cautiously optimistic about stock. Exactly today what's happening, right? If you look at SIPs, and I've been writing a lot about SIPs, I think SIPs is like a ticking time bomb. We are not willing to accept something's going to go wrong. Something will go wrong. Could it be a global recession? We don't know. Data from China is horrible. Europe is horrible. US, suddenly everyone believes it's a Goldilocks economy, nothing will go wrong. Well, anything can go wrong, yeah. No short-term view, but I think equities look brilliant from a long-term perspective. But the fact is equities have always looked brilliant, going back right up to the 90s, early 90s. The fact is there'll always be intermittent sell-offs. So when you are making your portfolio, you have to be very careful. You're not discounting far too much into the future today.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter. And on today's episode, I'm talking about asset allocation with our guest Rahul Goel, former CEO of Equitymaster. We'll be talking about asset allocation, how it's different from diversification, mistakes that a lot of retail investors make, and much more. Okay, guys, for those who don't know Equitymaster, I mean, you should, of course, that's the first thing. Please listen to our 25th April 2022 episode where we featured Rahul Shah. Of course, who we have is Rahul Goel. But Rahul, welcome to Paisa Vaisa. Thank you so much for doing so our listeners.
Super delighted to be here.
Yeah, considering the kind of work you've done at Equitymaster, I'm just wondering, we should have probably done this earlier than
Well,
later.
my colleagues were coming. Rahul Shah was here.
Rahul Shah was
so
here,
that was great.
A good way to start this would be tell us about yourself, and your, as they call it these days, the journey, how and when you became part of Equitymaster, right up to, your decision to move on.
Yeah, sure. So I think the journey that makes sense for the readers is really the Equitymaster journey. And the fact that I got associated with Equitymaster was pure luck, serendipity. Okay. I'm from a boarding school, very disciplined. Came to Bombay, joined Sydenham. Those days, very reputed.
Of course, yeah.
What I did not know is that Sydenham really didn't have classes.
Oh.
So if you went to college at 8 a.m. in the morning, the classes were actually locked. Forget teachers and students. The classes used to be locked. So very quickly, I got disillusioned. Nothing to do. And so I bumped into my teacher from Sherwood, and he introduced me to the founder of Equitymaster. That time, Equitymaster was not born.
Yeah.
And that's how the whole thing got set into motion. Initially, we were publishing a book called the Quantum Stock Market Yearbook. So I would go, travel all over Bombay, wherever you could get access to annual reports, plug it into a system along with a team of people and make those fact sheets and publish it in a book. And then the founder of Equitymaster, Ajit Dayal, had this brilliant idea. Why don't you put this information on the internet? This is 1996, 95, 96.
Shell account?
Where people can, slice and dice. And what have you, we were born on the internet, still not called Equitymaster. I think it was called webindia.com/quantum or something like that. Yeah. And the rest is history. Yeah. So, we just kept working. One thing led to another. I, of course, took a break to do my double postgrad and then came back and never looked anywhere else. Yeah. Spent the next 25 years flat out at Equitymaster.
Ajit's been on our show, so I think he was there again online, I think last year somewhere, and he's always he's such a pleasure to talk with. He's amazing, a veteran.
Superb. Yeah.
His way of thinking of empowering the investor has always been something that stands out. I think Equitymaster was the very first subscription product for retail investors. Did I get that right?
That's right. 2002, I would say, probably. Yeah.
And the offering then has just evolved and it's there today as well, right?
Yeah. Yeah. Now it's a whole bouquet of services meant for various investors. But the common thing across everything is we don't guarantee 100% success record. We guarantee 100% effort and 100% honesty and transparency in what we do. Yeah. That is uncompromisable. That's what helps us, keep our heads high and sleep peacefully and no hanky-panky.
Yeah, because you're paid for by the subscriber herself.
Yeah.
And that's the reason why you can be as independent, as candid as possible.
Yeah, no, but even in our business, in our industry, people take shortcuts all the time. Yeah. You can see all the SEBI orders coming all the time on what people are doing. We chose to walk the right path no matter what the cost.
Okay.
It's tough, but works in the long term.
Yeah, sounds good. I want to build on that, Rahul. What's your take on retail investors? When you came in 1996, product came out in 2002. Here we are, 2024. When we were recording in 2023, the episode will be out somewhere in Jan of 2024. What's been this journey? Because you've seen it for what? It'll be like almost 30 years now.
Yep.
What's your take?
So, at one level, retail investors are still making the same mistake. They give in to too much greed or too much fear. But the trigger for those mistakes is kind of changing. Those days, it was lack of information. They didn't even know the basics of a company, and they would go and trade and punt and get carried away and lose their money. Now what's happening is that there's too much information. And the fact that there's too much information doesn't mean you're able to glean away a sensible idea. But they just feel they know, and they are, again, getting driven by greed. Exactly today what's happening, right?
Yeah.
If you look at SIPs, and I've been writing a lot about SIPs, I think SIPs is like a ticking time bomb. The number of people who've done SIPs in small cap and mid cap funds, it is just shocking.
The highest number. I just saw a graphic somewhere. It's floating around everywhere. In the entire SIP book of some 17,000 odd crores, small and mid cap are the highest.
Yeah, I publish, I'm writing a column for Mint, and I put the table out there every month or whenever I write. It is shocking, and not one person from either the mutual fund industry or an independent advisor or the regulator has warned the retail investor not to get carried away. SIPs are good, no problem. They're a good savings instrument, not necessarily a good investment instrument. For it to become from a good saving to a good investment, you have to select very carefully where you do the SIP. And right now, so the basic point, retail investors are making mistakes still, driven by greed and fear. The fundamental thing that remain unchanged, just different mistakes.
Yeah. I wanted to just drill that down a little bit further. When you say that it's a ticking time bomb and the fact that the numbers are actually quite big, what could go wrong? Let's look at it that way. I mean, now, so of course, with the market where it is and small and mid caps have been on a tear for quite some time now.
Mm-hmm.
What could go wrong? I don't think people are thinking about that. Tell us.
See, in the market, you never know. It's very difficult to predict what will go wrong. But what you can say with a high level of certainty, something will go wrong. In 2022, none of us had predicted that the markets are going to collapse. Even though there were signs, but no one really acted on it. Even when Russia attacked, sort of claimed territory in Ukraine, even then the market started correcting, but they did not collapse till May and June of 2022, right? So it's just psychology. We are not willing to accept something's going to go wrong. Something will go wrong. Could it be a global recession? We don't know. Data from China is horrible. Europe is horrible. US, suddenly everyone believes it's a Goldilocks economy. Nothing will go wrong. Well, anything can go wrong, yeah. You asked this question. I remember 1999, I would write a market commentary. And the number one concern used to be border issues. Because we used to have issues with Pakistan, right? Today, no one talks about all this, right? But these are still issues. Maybe the China border. So investing is all about managing risk. And I think if people ignore that, sooner or later, they're going to get hit and they're going to take a knock. And if you have more small cap, mid cap, the knock's going to be far more than what it would be in a well-selected large cap portfolio.
Yeah, as history has shown us time and again.
As history has shown, yeah.
Yeah. So, okay, big picture, general outlook on equity and debt markets going, now that the new year has just started in 2024, equity and debt, like you said, anything could go wrong. And the fact is that we never think about it when the markets are at an all-time high. So what's your take going from here?
So no short-term view, but I think equities look brilliant from a long-term perspective. But the fact is equities have always looked brilliant, going back right up to the 90s, early 90s. The fact is they'll always be intermittent sell-offs. So when you are making your portfolio, you have to be very careful. You're not discounting far too much into the future today. So for example, if you're investing in small caps, the reason small caps are looking good because you're saying, in 2032, the stock's going to do very well.
Oh.
Yeah, we don't even know what's going to happen 2 years or 6 months down the line. And you project it up to 2032. That's when mistakes happen. And that's when people lose money. So if you can plan your portfolio well, have a mix of large caps, small cap, mid cap. Usually large cap should be at least 2/3 of the portfolio. Selected well, and that will control the volatility in your portfolio. And I think if you stick with it over the next 5-10 years, I think you should do very well. That's what I'm betting on, right? India's got a bright future. Here's a line I wrote in one of my pieces with Mint. Be super bullish on India, but be cautiously optimistic about stocks.
Nice.
That's the approach I think people should have. On debt, my view actually changed. So the other day, Diwali is just gone by. All Diwali dinners are happening. So someone popped a question to me, Rahul, would you buy a 50-year government bond? I said, no, not in India. And then this question stayed with me. I went home, thought about it, and I realized I may be making a mistake. And the mistake is that if interest rates in India have peaked, right, and if you're looking at a benign environment for the next few years, even debt could be very attractive. Now you have to, these are all technical things. You have to study very carefully, etc. But they are, irrespective of the fact that the markets are all-time high, I think there are very attractive investment opportunities available to the sensible investor today, outside of the small and mid caps.
I find it really interesting that you mentioned that at Diwali party, someone asked you about debt, because you would have seen the market over the last, like I said, 30 years. Kind of question that gets asked at any party, not just Diwali, is kya lagta hai, kya kharidne ka, right? Debt is something that's relatively new. And it's also opening up a lot, because a lot of people, fintechs who've also been on a show, are doing something very different. And people are probably questioning the wisdom of putting in FD versus debt mutual funds, etc., etc. But I don't want to get into that. In your conversations, in your experience, whatever you've seen, how has debt investing evolved? Are people more aware? Because debt is a seriously complicated market. Now, I'm an equities guy, and I've always thought that, just by numbers globally, debt is much bigger than equity.
Much bigger.
And usually debt is like a lead indicator where equities will go. Anybody, that's quite logical. India is just kind of at the early stages of people trying to figure out, okay, these are the options, etc. So what's your view on the debt landscape
I think if you are an investor in debt in India, you are looked down upon. I think, you're not going to get any pat on the back from anyone for being a debt investor. So I think what's happened is that one is the institutional framework, which has been very, very limited to the large investors. And the other is the fact that no one even explored it. Who wants a 7-8% risk-free return when theoretically you can get a 25% return in stocks? But it doesn't work that way, right? For the last few decades, the 60-40 portfolio in the US has been gold. 60% stocks, 40% debt. And I think the same thing could happen in India, but we need to get those debt instruments available. I still think that market is shallow. I did read in the press the other day that the RBI is taking even more steps to make it retail friendly. I don't know whether you've accessed the website, RBI Retail Direct.
I have. I opened an account and that's all I could do.
I did the same thing.
I couldn't move any forward.
And I couldn't understand what to do.
I don't know what were your reasons for, going back and questioning the 50-year law. The 50-year bond that you just mentioned, your initial action was you said no. And then you went back and you said you'll think about it. What changed?
Well, if you lock in a high rate of interest, it's a great idea. The reason is because interest rates possibly in the next couple of years are going to go lower in India. And the longer the bond, the bigger the capital gain when market rates reduce. So it's like a nice 1, 2, 3 year capital gain opportunity, not the coupon. In a country where, if I asked anyone what is the rate of inflation, they're going to say our household budget is at least 10% going up every year.
Absolutely.
And if the bond is giving 7%, it's a waste of time. You're losing money. So it's an opportunity to make a capital gain more than anything else.
Yeah, but see, you get the capital gain part. I probably get the capital gain part, but I don't think anybody should be going into a GSEC directly buying from RBI expecting an FD-like situation, because
not at all.
This is capital at risk.
Debt, and I learned this from our founder, Ajit Dayal, debt can be far more risky compared to equity also. So that's a big disclaimer. You have to be really either be aware or stay away from it.
There is a case, obviously, if you're looking at a 30-year debt, 30-year GSEC at what, 7.5, 7.6%. And if you do nothing, just hold on to it each year. And there's sovereign, so there's no default risk. The government is going to pay you that much each year for the rest of, the bond period. So But capital risk, you're right about that.
Yeah. Now I'll give you a nice tip over here.
Go for it.
So you said 7.5%, right?
Yeah.
Now, if you go in the RBI Retail Direct, you will find bonds issued by state governments, which for the same tenure will probably give you 8%, right? You should buy the 8%. The reason is because I think, and if someone, you should verify this, RBI is on record having said that state government bonds are sovereign risk. They will never default. So if I have two bonds, 7.5 and 8, I definitely take the 8 if the risk is the same.
Yeah, I don't know about that being sovereign or whether there's a
Yeah.
backstop out
You
there
should-
by
You
somebody.
should double check, but I
yeah.
think the RBI is on record to say it. I actually did search. I think they've definitely said it.
Yeah. I mean, and folks, please, these are bonds, buying
Yeah,
them directly
double-edged.
versus buying by a debt mutual fund. You should please do your research. Okay, now let's get into the topic of this episode, asset allocation. I want to understand the meaning, okay? Because a lot of times I get, people talking about asset allocation, but they don't understand how it's different from diversification. And there's a whole, there's some amount of confusion out there. Let's understand asset allocation on its own, how it's different from diversification, and why both are actually important for your portfolio.
Yeah. So I don't know what the textbook definition is. What I think of asset allocation is it is something that connects your financial goals and plans to the actual realization of those goals and plans. So you can say, I want to do retirement planning. I'm going to invest 50,000 rupees a month. I hope to earn 8% per annum or 10% per annum or whatever. And I'll fund my requirement 20 years down the line. Well, you got a plan, you got a goal. The allocation will connect the two. The allocation is going to tell you where to put your money. How much stocks, how much debt, how much real estate, how much gold. That's asset allocation. It's way beyond equities. I think when I read in the papers where some people go online and say we got 99% of our assets in equities and all, I think that's very dangerous. It could work for some people. For most people, it's not going to work because it's going to be a very volatile ride. So think of asset allocation as optimizing your wealth in a way that helps you achieve your life goals. That's what asset allocation does. It's something I've seen most people not do. It's a waste. If you went around asking your friends and family why you're investing, they will all say we want to generate wealth. Very few link it to a real life goal. And that's what makes it troublesome, because if you are just chasing wealth and you don't have an anchor, that's when you do the racy stuff trying to earn the highest return. But if you knew you could live a very comfortable life at 12% per annum and you optimized your assets for that, imagine the calm you'd have and you'd get there, as against just chasing a 15, 20, 25% return. So yeah, just it's insurance, the way you allocate the way you invest your assets across asset classes.
Yeah, diversification.
I read this quote from Charlie Munger recently. He said, diversification is diversification.
Oh, WRSC.
WRSC. So, incidentally, and I didn't realize it till then, I actually also prefer to be very concentrated. So, for example, if I'm investing in equities, I tend to buy direct stocks, but I also have mutual funds. I think 99.9% of my equity fund allocation is in one scheme only. Similarly, in my stock portfolio, my top 4 stocks are probably 85% of my portfolio. And I believe that if you know what you're doing, if you have high conviction, then you really have to bet big. You wait, you find the right opportunity, and you bet big. Too much diversification only takes you down to the index return. In fact, I wrote a piece on this.
Sure.
The people end up with 4 or 5 mutual funds in their portfolio, equity funds. I added up all the stocks. It comes to about 227 stocks. If you own 227 stocks, those are probably all the investable stocks available to someone today. The good ones.
The good ones, yeah.
So which means you're going to get an average return.
Yeah.
So how do you sort of try and get a better than average return?
Sure.
So so diversification I'm not a big fan of.
Okay.
But then on the other hand, it's like a big disclaimer. A concentrated bet can It cuts both ways.
Both ways, yeah. I was just going to come to that.
If you're not really good at it, you shouldn't do it.
Yeah, and this is, I mean, you are someone who's seen the markets. You would not, I'm assuming, not give this advice to someone who's new to the markets.
Yeah, new to the market, I'd say go via a mutual fund route.
Yeah.
Select a fund, like the fund I invest in. I think they have 30 stocks. That's it. That's
And choose something that's, aligned with your
Yeah.
philosophy. So, what do retail investors get wrong with asset allocation? If you were to make a laundry list of the mistakes, one though we already spoke about, saying that small and middies are the highest on the SIP book, what would your list of mistakes look like?
The allocation shifts depending on which market cycle is at its peak. If today's small cap, mid cap are peak, a lot of the allocation shifts to that. Tomorrow, if real estate is peak, assuming you have the kind of capital, it'll move to that. So you are buying into inflated markets. But if you think about it rationally, you would make money. The famous Warren Buffett quote, right? You have to be greedy when others are fearful. I don't see retail investors doing that. Like, again, no tip, do all your homework. Today is the time to be invested in large caps. Everyone who you respect in the market, you talk about Naren, you talk about any S. Naren at ICICI Mutual,
True, yeah.
everyone's saying, why would you invest in small cap? Yes, they will do well, but they've already run up. You might as well go into large caps. You look at the mutual fund stats. July, August, September, large cap funds actually lost money, while small cap, mid cap thematic funds gained some 40,000 crores. So the retail investor, like I said, it's a greed and fear cycle that is playing out. And I think that's not doing them a lot of justice. And that's why, the markets are all-time high. How many people have created real wealth? They have entered now with the hope of creating wealth in the future. I hope it works out, but, history suggests it does not really work out very well for them.
I mean, what I find interesting is this entire investment that people have been doing post the crash of the lockdown in March 2020, and that was, I believe the Nifty went from some 12.5 to 7.5, some 35% odd correction. After that, this market has only seen 10-12% corrections over the last,
That's right.
It'll be 4 years next year. And no one's ever seen that kind of a shock so far. I hope that the SIP book sustains, but look at it from the investor's angle, Rahul. How do you choose a mutual fund? I mean, if there is performance itself, behaviorally speaking, because now there's a lot of literature on this, which didn't exist, by the way, 30 years ago. How should they choose a mutual fund if not performance? And and there are tons of mutual funds out there. Someone who doesn't understand the space, okay, and probably can't afford an advisor also. How should he choose a mutual fund for his goals?
It's very tough. Very, very tough. So I have two daughters, 16 and 11, and they just started investing in funds. So I had to suggest. So one fund was easy to suggest, the one I'm investing in. And to select the second fund, it took me weeks to find.
Okay.
And ultimately, I came to the conclusion, and if someone asked me, and you're asking me today, is that select the fund manager, the fund management team, and give them the flexibility to invest where the opportunity is. Now, it's easier said than done. Retail investors, what they tend to do is they'll say, invest in the capital goods fund, invest in the small cap fund. And I'm saying, why restrict the fund manager? If you've got the right fund manager, fund management team, give them the money and allow them to invest. You are investing for 10 years. Every market has its own mini cycle. Let them move around. I'm afraid I don't have an answer for you, but I can tell you it is very difficult to select a fund. Common mistakes, like I mentioned, people end up having too many funds. People end up having thematic funds. And they're all very widely distributed. Effectively, they own the whole market. Net, they'll earn the same return as the index.
I mean,
unfortunate, but that's what the reality. That's what I see every day when I meet people.
And what about social media? See, this wasn't there 30 years ago. Okay, today now we're dealing with noise that how dare a mutual fund put his money in XYZ IPO that apparently they don't like because it's come at some lofty valuations, and how dare this, that. And I think it was Neil or Sashi at Mint who said that, that investment by a mutual fund whose AUM run into 10,000s of crores is probably put in 10 crores or 5 crores into an IPO which you do not agree with. The rounding of error for them. But social media noise and behavioral finance make life very tricky.
So unfortunately, I'm on the other side of the argument, and I'll explain.
Please.
Uh, if a small cap fund bet on the IPO, no problem. If a large cap fund, where the fund manager talks about following Warren Buffett's principles, long-term investing, value-oriented, if he bet on that fund, even if he bet 1 rupee on that fund,
IPO.
I have an issue.
Okay.
Because you're not sticking to what you promised you'd do.
The philosophy.
So because today if I overlook that, tomorrow you'll do something bigger and bigger. And I'll tell you what, the fund I invest in, they don't do any of this. They've never done any of this.
That's a nice lesson to take away. Yeah.
So I the other day I was on a space and I said, here's a thumb rule. If your fund manager invested in a racy IPO, which was not part of the mandate, strike him off your list.
Yeah. Yeah.
You can't justify it by saying it's a small amount. Because, it's money after all. Every rupee, it's a fiduciary responsibility. Every rupee counts.
Correct.
And why don't the other good funds do it? They don't do it.
Very interesting. Very interesting. Okay, now let's get some tips across for our listeners. Okay, I want two things from you. The first question is, you spoke about your daughters, 16 and 11. Let's fast forward 10 years. Okay, let's look at a 25-year-old who's just starting off, probably his first job, new to the market, new to investing. Forget markets, new to investing, getting his first salary. What are the few things that you would tell him or her about asset allocation?
See, when you're starting off, the amount of money available is very little, right? And there are two challenges at that stage. You have real life needs. You're probably looking to get married in a few years. You need a home. On the flip side, the earlier you start investing in stocks, equities, the better it is. So, no easy answer again. But I would say that if you are young and starting off, here's the answer. It
Go
just
for
struck
it.
me.
Yeah, go for it.
So, this is what I'm teaching my daughters. I don't know whether they'll learn it. So, the principle I follow in life, at least I try to follow in life, is income less savings equals expenses.
Can't get more buffet than that. Warren Buffett said this, I think.
But
quite
what is
something,
happening now in today's generation? You ask me about problems with retail investors and Diwali lunches, I'll tell you something.
Okay.
What people are doing is income less expenses, zero savings or negative savings, right? So in the same Diwali lunches, I would turn around and ask, are you guys investing in stocks, equities? I think 90% said no. No cash available. No funds available. Why?
Okay.
Because it's gone into cars, it's gone into residential large apartments, it's gone into large holidays, which I think is perfectly fine. But if you had followed income less savings is expenses, you could have still squirreled away some money into investing, which would do you a world of good. And I think if you follow this principle, no matter what age you are, I think it'll hold you in good stead.
Yeah.
It won't make you very popular because you won't have stuff to post on your social media very often. But you do well, I think, in life.
Okay. And setting up the portfolio. Like now that I've got my number, I've done income minus
savings.
Income minus savings is equal to expenditure. So I've got my savings number from there.
Yeah.
I'm ready to go. So what would be your, you already said that choosing a mutual fund is really difficult. Anything beyond that about actual setting up the portfolio from scratch, from day one?
Yeah.
How should they go about doing it?
So if you don't have the temperament or understanding of stocks, don't touch it directly. Go through a fund. It's not easy to select a fund. Do the hard work. Find a honest advisor.
Choose a team, like you said. Yeah.
Choose a team and go down that route. There's no easy answers. See, investing. What's that very famous phrase? Investing is simple, but it's not easy.
Right.
So if you learned how to select people and teams, your life's made. But if you're trying to complicate things by guessing, why is my large cap fund manager not buying small cap stocks today? Because you're just complicating the whole thing.
Yeah.
So stick to the basics, learn about people, see their track record, go and listen. Even to date, I log into all kinds of analyst meets, listen to conference calls. I hardly have any stocks in my portfolio. Probably have 7 stocks in my portfolio worth anything. But the point is, over time, you'll develop the experience on how to select management,
Sure.
fund management teams, and start investing slow and steady.
Okay. One of the easiest ways that I find today for someone who's starting off an investment journey at a young age to at least get to know the market, is, and this is what the guests on the show have also said as a general rule, is just go for an index fund. Not even an ETF, because that's a little bit more evolved than an index fund in terms of, I mean, they both do the same thing, but what's your view on active versus passive?
So I've not done passive. And so 20 years, let's rewind back to 1999. And you said, Rahul, active versus passive. And I would say active. The reason is India is an under-researched market. And if you found a team which is adequately smart, they can easily beat the index. And that's what happened. I think with every passing year, as the market becomes more deeply researched, to get that alpha, what they call in the market, is going to become increasingly difficult. So if you can't find the fund management team, go for passive. How do you select passive? Again, don't do a passive in a small cap index fund. Or if you're doing it, make sure it's only 5-10% of your passive funds. So select that well. And the other thing about passive is you have to keep costs in mind. It's all about the cost.
Yeah.
So I remember in I don't think there were index funds in 99. But whenever the index funds first launched in India, they used to have a similar expense ratio as compared to active funds.
Yeah. I think it was probably Benchmark which did this Junior
Yeah.
Bs and Nifty
Yeah.
Bs and all that. Yeah.
Now, of course, it's different. So you get that delta savings. Yeah. So it depends. If you can pick the team, go for it. I'm still not into passive. But I bet at some point in time in the future, passive will make increasingly a lot more sense.
Yeah. Okay, so we are done with the show. And my last final question, our standard question, is book recommendations. Any book that you're reading, anything that you've read recently, anything that you'd like to share with our listeners?
So I think the best book I've read this year is Pulak Prasad's book. I'm going to name the book wrong, but it's something about what I learned from Darwin about investing.
That's it.
It's Pulak Prasad's book.
Yeah.
A brilliant book. I would recommend everyone read it. I just read this Sunday a relatively short book by Chris Mayer. It's 100 Baggers. Now, I know the name sounds racy, but it's nothing about like picking a stock and it goes to 100. But I think that book is very essential reading for anyone who's a long-term investor, because it tells you what to look for in a company which you want to hold in your long-term portfolio. And of course, there's the other book, Joys of Compounding, by Gautam Baid, I think. Gautam Baid. So some great book.
I'll just recap that for our listeners. The first one, of course, was what I learned from Darwin about investing by
Pulak Prasad.
Pulak Prasad. I hope that he writes more books, by the way. He's absolutely brilliant. The second was Chris Mayer. That's M-E-Y-E-R.
M-A-Y-E-R.
M-A-Y-E-R, 100 Baggers.
100 Baggers.
And the third was Gautam Baid, Joy of Investing.
I think it's Joys of Compounding.
Joys
maybe.
of Compounding,
Something
sorry.
like that.
So, folks, there you go.
I'm sure people will figure it out.
3 recommendations from Rahul, and that is a wrap on this episode of Paisa Vaisa. My guest, Rahul Goel, former CEO of Equitymaster. Rahul, thank you so much for doing this for our listeners.
It's been wonderful. Thank you for having me.
Sure. And that is a wrap on this episode of Paisa Vaisa. For more in-depth discussions on various financial products, subscribe to Paisa Vaisa with Anupam Gupta. That's me on YouTube. Elevate your financial knowledge and empower your growth. You want to reach out to me? I'm your host, Anupam Gupta, B50 on Twitter. My book, The Wisest Owl, is available online. Check it out if you want. And you can also check out other interesting podcasts on the IVM network. You can follow us on social media. We are IVM Podcast on Twitter, Instagram, Facebook, and LinkedIn. Thank you once again, folks. Thank you for listening to Paisa Vaisa.
IVM.